Now, if you clicked on this video, then you are in for an absolute treat, because by the end of this video, you will completely understand how to invest in property from the very beginning to the very end. And this is all completely for free. And this is something that buyers agents and property gurus charge tens of thousands of dollars. And I'm giving it absolutely for free. Why? Because I am aiming to change this industry. And this video is going to be a very long video, so you may want to watch this in segments and come back to it every so often depending on what part of the journey you are on. But I'm going to teach you everything from identifying your investment brief, your risk profile, your strategy towards suburb selection, then property selection, and then also looking at comparable sales, etc., placing an offer, and then talking about the details of the property transaction itself. There is going to be so much value in this one video that it's absolute no-brainer for you to watch the entirety of it. And throughout this video, I'm going to promote multiple products because this course is going to be jammed-packed with so much value that you would be willing to sit through everything. And I guarantee that you will find amazing value through this entire video. And so before I get into the first component of identifying your brief, risk profile, and strategy, if you have not already, make sure you are subscribed to my private community. It is literally $35 a day, about $1 a day. It's an absolute jam-packed with value. There are over 140 members in the community already. Everyone is sharing ideas, everyone is sharing tips, and we're talking about every single location in Australia and picking the best ones for the people to invest into. So if you haven't already, make sure you are subscribed. But let's get into the video, into the first part of the property investing guide. All right, the first part of investing in property is to actually identify your brief, your risk profile, and your strategy. It is not good enough to simply just ballpark what property you should buy or what location you should buy. Intelligent property investing is about choosing the specific location to invest in based on your risk profile, your investment profile, and your investment strategy. It is not as simple as throwing a random dot on the map of Australia and picking the location. And I'm going to teach you exactly how to identify your brief and your risk profile and strategy. And it's actually a lot more simpler than you think. And by the way, this is something I actively do with my consulting clients that I help with when they're looking to identify properties and locations to invest into. And so one of the things I do is occupation. So when you look at occupation, you either fall into two categories. One is you're a business owner, or two, you have a 9-to-5 employee. And to be honest, I don't care which one you are, but you need to know exactly where you stand along that line. If you are self-employed, that means your income is likely to be more unstable. You run a business, your month-to-month cash flow could be very different, especially when depending on what business you're running, it could seriously vary month to month. That means you are a higher risk investor. You might require properties with greater cash flow because your own income alone is unstable. Whereas if you're a 9-to-5 employee and you work in a big corporation, a big tech company, or a big engineering company, then your income is very, very stable. You have a set salary every single month, plus bonus, plus superannuation. You are in a stable position. So you can look at properties that have lower yields or require more cash to actually hold the property. That's occupation. The next one is your budget. Now, your budget isn't some magic number that you come up with. Your budget is dictated by what your mortgage broker says you can borrow. If your broker says you can only borrow $550,000, then there is no point for you to look at properties at $600,000 or $700,000. You look at anything $550,000 or less. Your budget will really determine where exactly you can invest and which locations you are not allowed to or you can't access because of your budget. The next one is the number of properties in your portfolio. If you have 0 properties in your portfolio, if you're in your first investment property, then you may not want to actually invest into higher risk locations like Gladstone, for example, or into smaller locations like places nearby to Dubbo, or into other places like Hamilton in Victoria, which are very, very small locations and have higher risk. If you're on your 5th or 6th investment portfolio, then you may want to consider investing into higher risk locations like Gladstone and other locations for that fact. But if you're on your 2nd investment property, then you may only want to consider capital cities or large regional locations like Bendigo, Townsville, etc. The next point is emergency savings. Emergency savings is so critically important. I like to have about $10,000 for every single property saved up. And the reason I say that is because $10,000 is only really going to cover one major fault. Say you need a major roof replacement, then $10,000 is going to just about cover it or most of it. But say you have 2-3 properties, then $10,000 is not enough. You need about $20,000 to $30,000 saved up in an emergency fund so that you have access to that money at the touch of your fingers to actually go and fix up the issue. And the reason I say emergency savings are so important is because it actually helps you build your mindset and your mental fortitude when things go wrong. Because let me tell you about something in property. It's not a matter of if things go wrong, it's about when things go wrong. Because things will go wrong and you need to be prepared for that. And if you have 3 properties and you have an emergency savings of $10,000, trust me, you're going to have a financial situation where you will be wrecked. So save up your money. The next point I want to make is investment time horizon. Now, investment time horizon could mean you only want to buy and hold a property for 3 years, or you want to buy the whole property for 5 years, or you could be a long-term investor and hold it for 15 years. And this is important because say you're a short-term investor and you only want to hold the property for 3 years, then maybe you can consider locations in like Darwin in Palmerston City, which are known to go through cyclical changes. Or you could go back to Gladstone, which is a high-risk location, but it's growing rapidly at the moment. But if you're a long-term investor holding for 15 years, then you really want to consider more like capital cities or nearby regional locations like Bendigo or Melton or Townsville, which are large regional hubs. And that's why investment time horizon is so important. Then you have risk profile. Risk profile is also important. If you're a high risk investor, right, you like to take chances. You have a bit more cash saved up. You want to take that chance where you can make big reward for big risk. Then you want to be a high risk investor. You might be a low risk investor. You might have multiple kids. You might not have as much emergency savings. You just might not have that mental fortitude to go for that higher risk options, which is completely fine. But you need to be sure about that. And then you're a low risk investor. And that will help you determine locations. And this type of investor strategy also comes down to investment time horizon. But sometimes if you're looking for short-term growth, 1 to 5 years, you need to target hot markets. If you're a counter-cyclical investor, then you can look at markets which haven't grown significantly in the past 3 to 5 years and buy there, waiting for the next complete growth cycle. If you're a renovator or DIY person, then you can find markets which have under market value properties which also have renovation potential, and you go in and you buy those type of properties. The next point is capital/regional. You want to be deciding whether or not you're actually open to regional areas or not, or whether you want to stick to capital cities. Because believe it or not, a lot of individuals out there, a lot of clients I work with, a lot of high profile buyers agents and clients that I work with actually have people who do not want to invest regionally and they only want to invest capital cities. So options become limited about which areas we can go to. And that's another important factor you need to consider. The next one is building type. We need to look at whether you're looking at houses, townhouses, apartments, or you're even looking for vacant land to develop on. This is all important because if you're specifically looking for a house, then and you only have a $500,000 budget, then maybe you can't get into a capital city. So we look at regional areas. But if you're open to an apartment, for example, and you only have a budget of $400,000, we can easily get you into a location like Melbourne without blinking an eye. So this is why determining your client profile and strategy is so important. And so a really common one is you're an employee, you usually have a $650,000 budget, you're on your second or first investment portfolio, you have, $20,000, $10,000 in savings, and you're a long-term investor or you're an investor for about 7 years. And your risk profile is you're a medium risk. You want short-term growth, but you're also looking for that long-term hold as well, capital city, and you're looking for a house. And to be honest, this is what a lot of investment briefs look like. This is what I would say majority, 80% of people's situations are. They're very medium risk. They don't want to take too much risk, but they're okay to take a bit more risk. They're open to capital cities/regional areas, etc. And they have a good income, $80, $90 to $100,000, deal income $200,000 or more, and then you get the $1 million budget portfolios, etc. But this is an example of one. So just to run you through this example, say a $650,000 budget, I can tell you right off the bat, okay, we can look at capital cities in Melbourne, investment time horizon of 7 years. Yes, we can look at a growth cycle, medium risk, which means we can also look at regional areas, short-term growth like Bendigo or Albury as well. But really with this sort of investment profile, I'll be looking at Melbourne. And this is without even me looking at the data. It's just something I know off the top of my head about which areas I would target in this person's situation. And yes, I do a lot of consulting for individuals and clients and buyers agents, hence why I know a lot of areas simply off the top of my head. So the first exercise you need to do, or the first part of this video, was identify your brief, identify your risk profile, and then your strategy. It's so important you do these steps. And just before I go any further, I have a huge announcement to make, and that is I will will be releasing an education program where I will be able to take you from a novice investor to one of the top 1% of property investors out there building lasting wealth. I will show you strategies, tips, ideas, and knowledge all throughout this program, making you into one of the best investors out there so you can simply replicate what I have done. You'll also get 6 months free access to the private community. There will be 8 in-depth modules with over 50 to 60 plus videos and hours of content in bite-sized chunked videos. The videos will be 5 to 10 minutes long, and they will be jam-packed with information that you will be able to actively use to find your next investment property. And you may be asking me, hey, why are you doing this program? Why are you doing this education service? And the reason I am doing this is because the property community is filled with courses from buyer's agents to property podcasts to other property gurus who all charge anywhere from the region of around $5,000 to around $10,000 for a property course. And that's not me. I am trying to forcefully change the game, right? I am making the barrier of entry even lower for education when it comes to property. And it will be on pre-order for $299. It is an absolute steal. There are so many videos in this course, so much knowledge jam-packed into this that it is an absolute no-brainer for you guys to sign up. And this pre-order special is only for the first 20 members. And this pre-order special is only available for a very limited time, only before the course is actually released in April. All right, so make sure you go in and you buy the course and pre-order it. And for those of you who are already part of the private community, you will have a special discounted rate available to you. And make sure you buy the education program because I am aiming to change the game and make property education that much easier for you. And even if you don't want to, make sure you watch the rest of this video because there is still so much knowledge that I want to unload onto you guys so you will be able to invest into property in an intelligent manner. Welcome to the next part, and this is all about choosing the right location to invest into. Buying into property is all about choosing the right location and then the right property. And in property, 80% of the value or 80% of the growth in a property is done at the suburb level, not at the property level, at the suburb level. There is no point buying the perfect property in an area that isn't growing or that doesn't have any fundamentals that underpin it. You're better off buying a worse quality property in a great suburb that will do the heavy lifting for you. And there are some key fundamentals that you want to look for when investing into property, and they are here. And I'm going to break that down for you. Now, this may seem like a lot, and it is, but the best way that we're going to do this is by identifying the markets where you should be investing into. And if you have not seen already, you would have seen in my other video where I show you a strategy to identify hot and cold markets. And in that video, you will be filtered out a list of suburbs based on various different metrics, including supply and demand, rental yield, as well as vacancies and more, including building approvals and more. These metrics will identify you a range of different suburbs which you can consider investing into. And this may seem like a lot of metrics, and that's okay, because you can also tamper with these metrics and play around with it. Some of the important metrics are like days on market and stock on market, which supply and demand is. These are hot market metrics, and if I want to make them cool market, I can just adjust them as required. And we can see more and more suburbs get pulled into this pool over here, which I can do further analysis on. And the way you determine whether or not you want to buy in a hot market or a cold market is by looking at your brief. If you're really looking for that short-term growth, 1 to 3 years, then you want to be looking at a hot market. But if you have a long-term horizon and you're a counter-cyclical investor, then you want to be investing into cool markets or markets that are slowly growing, warm markets, so to speak. And there are a couple of things that I want to be looking for when investing into a location. Now, for example, after I put in all these metrics as seen in my previous video with supply and demand metrics, price growth, rent change, vacancy, and more, you'll filter out with a list of suburbs. And one of those suburbs is Edmonton, for example. And when we look at Edmonton, we can start to do our deeper analysis into this video. And there are a couple of things that we want to be looking at. I'm going to break it down for you. The first metric we want to look at is the market tightening. Is their supply and demand good? And the way we want to assess that is we go down to the days on market and the stock on market. In the stock on market, we can see that stock is rapidly declining and the days on market is also declining, which means there's higher demand. Now, in the last 3 months, we can see a little bit more or less demand in the area, but the overall trend is very, very low, as well as the stock on market. So when we go to our metric sheet, is the market tightening, supply and demand? I'm going to say yes, it is. Is the rental market tightening? The next metric I want to look at is the rental market tightening. And that's very simple for us to look at. The way we want to look at that is two things. We want to look at the vacancy rate. We can see the vacancy has been trending down. Now, over the last 8 months or so, it's been trending up. That could be due to more investor activity, multiple other reasons, as well as the timing going into Christmas, etc. But now we can see the vacancy is trending down, so the market is tightening. We can also cross-reference this with the increase in median rents. So is the market pressured there for rents to keep rising? And as we can see, the rents are rising. And so we want to look at these two metrics here, and we can say, okay, yes, the market is tightening, and yes, the rents are rising. Now we look at, has the suburb grown too much? Now, one of the things I like to look at is, have we passed the peak of the market? And over the past 3 years for Edmonton, we can see there's only 36% of growth. So it's less than 60%, so it's good. If you don't want to trust H-tag, for example, you can also go on to SQM research and you can look at the past 3-year change growth. Over the past 3 years, you can see it's about 16%, so about 48% in growth. So you can cross-reference the statistics, but it's still less than 60%. So I'm going to consider that location as yes. Is this location unaffordable or is it under 35 years? Let's have a look. It's under 35 years. So yes, this location is relatively affordable for the local residents in the area. Now, when you invest into capital cities will have a higher metric or a higher bar, and that bar is 45 years. Anything less than 45 years in a capital city is good. The next thing we want to look at, does the location have low building approvals? We can see building approvals is about 64, and yes, it's low. It's under 4% or so, or even under 2%. So it's very tight, very low. So I'm going to put yes. Does the location have low investors or more owner occupiers? And the reason we want to have low building approvals is because we want there to be less supply on the market. That's really good for us investors because it's always supply and demand. Does the location have low investors, which means there are more owner occupiers in the area? We want to be investing into areas where there are more owner occupiers because that is a more desirable area. If there are more investors, that increases competition. It also increases our risk in the market if those investors leave the market at a very rapid rate. And the way we check that is simply by looking at the renter to owner occupier ratio in the fundamentals, and that's sitting at 32%. Once again, perfect. That's what we like to see. Does the location have low unemployment? This is very important to see because we want to see that people have jobs there. If we have a rising unemployment, that means people could leave the area, properties can be vacant, rents start dropping, there's more supply on the market. That means property prices could either flatline or start dropping as well. As we know, Edmonton is in Cairns. One of the things we can do is go to economic indicators as well as go to unemployment. And in unemployment, we can see that it has been dropping rapidly. So that's a good bar for us, right? We know that unemployment is also decreasing. And you can see why I put yes. Does the location have a rising population? In a very similar fashion, we can look at economic ID or other sites as well and look at population estimates. And if we just put this up to here, over the past couple of years, we can see that there's about roughly 0.5 to 1% growth. Or a bit over 1% growth. That's pretty good. And it's not terrible. It's not great either. It's just average. So what I'm going to do is I'm going to put it's okay. And the reason we want a rising population is because we want there to be more demand in the area. If there's an increase in demand and lack of supply, we will have house price growth. It's as simple as that. Simple economics. The next one we want to look at is the location economically diverse or dependent on one industry. We have to do research for this. And the reason we want that is because we want to make sure that the location is not hinged on one industry. For example, in recent times, you will see that in Kalgoorlie goes through ebbs and flows because it's dependent on one industry. So if the mining collapses in that area, we will see house prices absolutely plummet. So we want to make sure we are investing into regions and locations which are very economically diverse. What do? You go back to local employment in the website and you go employment by industry. And over here, we can see by number or by percentage, we can see a breakdown of the locations and its economic diversity. And we can see that it's fairly diverse with no industry taking up more than 25% of the employment in the area. So it's a very good metric. And we can also say that's a yes. Now you can see why Edmonton is one of my favorite locations to invest into. We know that the location is not mining or agricultural dependent, which is good. We want to put no, but that's really a good thing for us. Does the location have good schools? And this is something you can also look on websites like microburbs. Now, when you look at a property in Edmonton, for example, you can also scroll down right to the bottom and you can see, like on this website or property.com.au, about nearby schools, nearby primary schools, nearby secondary schools, childcare services, and more. This is a really simple way to actually search up a location and the schools nearby, but also you can do manual research and you can find out and inquire about the local high schools within the area. And the reason we want good schools is because if there are good schools, that means it will induce families into the area, and the families, especially when they have kids in high school, are less likely to move away, which means it is a more desirable place for families to live, which is good for us as investors. So I'm just going to put that as okay. And does the location have major projects? And again, this is something you'll have to do manual research on about the locations and the infrastructure and major projects happening with the area. And the reason we want that is because we want money to be pumped into the area, we want jobs to be created, and we want the location to be stimulated so there is more demand, people want to live there, people want to work there, and more. It will increase the supply and demand of the area. So I'm just going to put that okay for now. Now, of course, do your own due diligence. Make sure you are researching to the area yourself and make sure you are looking at these metrics and you are ticking off the boxes to help you invest into the right location. Because if we look at another example like Shepparton, now this is just one that I've pulled out of the metrics, but we can see that there's not much price growth happening there. We can see the supply and demand trends has been rising over the period of time, but we can see in recent times there's a little bit of drop in this and a little bit of drop. So I'm less confident about the area, so I'm going to put okay. So let's have a look at the rental market. Vacancy rates, it's been rising, but it's been steady, right? It's not great, not good. And median rents have been rising as well with about 7% increase. But again, it's not like that downward trend we've seen in Edmonton, for example. So once again, I'm going to put that's okay for the rental market tightening and the rents are rising. Yes. Has a suburb grown too much? Let's have a look. 14%? Absolutely not. So I'm going to put yes. Is the location affordable? Under 35 years? So I'm going to put yes on this. Does the location have low building approvals? 0.45%, 71 approvals. That's a big tick for me. That's yes. Rented to owner occupier ratio, it's about 37%. So not under my 35% mark. So I'm going to put that's okay, right? It's not great. It's not bad either. Does the location have low unemployment? Once again, we want to look at this. Does the location have low unemployment? Economic indicators, unemployment. We can see unemployment in Victoria has been rising, but in Greater Shepparton, it has been dropping, which is really good for us to see as property investors. So what we want to do is simply go back here, select yes. Does it have a rising population? I know it has a steady population, so I'm going to put okay. Is it economically diverse? Yes. It's not agricultural. It's not really dependent on agriculture or mining, so you want to put no. So you can see out of these two, when you comparison it, you can see that Edmonton is a more favorable location for us to invest into because it has the core metrics of what drives capital growth. Supply and demand, good infrastructure projects, rental demand, tight vacancy rates, and it's affordable. That is what we really are looking at. These core metrics are what we want to be looking at. And so that is how you go about selecting the right location for you. And you want to be doing this for every single location that you are interested in, right? You put 4, 5, 6. And if you don't know how to find out which locations you're interested in, you have to go back to your client profile and brief, think about where you are in your life, where you want to go in your life, and what your investment goals are, and that will help you. And then you go and identify the markets using these metrics, as I've mentioned in the other video, looking at either hot or cold markets, and you narrow that list down. Once you narrow that list down, you go and put that onto the sheet like this, and you narrow it down to the best locations for you. And that is how you actually select a suburb. And yes, you can go even deeper into this, even more about analyzing exactly how you find those good schools, how you actually look at the economy, you understand the industry, and more. And that's where we go into in detail in the Property Blueprint Education Program, where we will help you understand every single thing you need to understand about property investing. And if there isn't something there for you already and there's a question you have, we will also upgrade, maintain the course so it stays up to date, and you only have to pay once, a very small fee for amazing property education. It's an absolute no-brainer. Go subscribe. So make sure you join now. Before I go any further, and for the next part of the video, we are going to go into property selection. I'm going to help you choose the right property. All right, welcome back to the next part of the completely free property investment guide, right? And in this part, I want to teach you everything you need to know about property selection criteria, the important things to avoid, the red flags and the not so red flags. What are they? And we're going to walk through each one of them. Right? The first one we want to look at is flood zones, right? We don't want to be investing into locations or regions that have flood zones because that's going to have higher insurance premiums and, well, your house might get destroyed in a flood. Simple as that. Same thing with bushfires. They have higher insurance premiums and more risk for your house. The next one is heritage zones. Heritage zones are also very important and critical. And the reason I say that is because it can have restrictions on the renovations you can do on the property, if you can either subdivide the property or develop the property. Heritage zones are a big no-no for me. I try to avoid them where possible, especially when we're talking about subdividing or renovating down the line. The next red flag is public housing. We want to be avoiding public housing at all cost because it reduces house appeal, it limits growth in the area, and you will not have good tenants in the area. You will have damaged properties, broken windows, etc. Avoid public housing where you can. Airport noise. We want to be avoiding airport noise because, well, let's be honest, no one wants to have flying aircraft above them. All you have to do is look at Western Sydney Airport and all the people that are complaining about planes flying over their houses. Think about what's going to happen to their property prices. It could be stagnant for a very long time. Major highways. We want to be avoiding major highways. Again, why? Because it limits house price growth. Think about it. No one wants to live next to the M4 or the M5 or the M7. It's not a good way to live. Council zoning. We want to be buying in low residential areas. Now, there is a caveat to this. We can buy in medium density residential zoning areas if the property that we buy has the potential to be turned into a low-rise apartment or a subdivided block of land where we can actually make use of the medium density residential zoning, right? Otherwise, we want to target low residential houses next to houses, not houses next to apartments. Now, these two are, me personally, I classify them as red flags. I hate pools and I hate buying near cemeteries, mainly because I don't want to buy next to a graveyard. And for pools, I don't want the increased maintenance costs. It's not worth a headache, in my opinion. When I buy property, I am an extremely selective person and I have very serious red flags and boundaries which I do not cross. That is my mindset when approaching it. So that's the red flags, but how do you approach that? Now, say for example, and I'm going to use Shepparton as an example over here because it's just a really easy one to me to show you guys how to do it. I go to layers, I go to zones, and I can see, okay, there's overlays, and here I can see bushfire zones. So I want to take the bushfires. And you can see almost immediately about, 20-30% of Shepparton is completely removed from the area. In heritage, we want to look at the heritage zoning laws, see if there's any heritage properties. We can also look at land subject to flood and inundation. So that's something I know off the top of my head. So we go here, flood, land subject to inundation, and we can see more areas of Shepparton actually disappear from it. There's also the floodway overlay. And if I go here and take that, okay. So now if you look at this, we can see all the bushfire zones as well as all the flood zones, and that takes a lot of the locations of Shepparton out. However, a lot of these pockets where it's pink, these are the areas you want to be targeting in terms of buying in Shepparton, for example. You don't want to be buying in the flood zones, you don't want to be buying in the bushfire zones because they will have additional premium price tags on it. You want to be buying in the pink zones of Shepparton. That is the goal, right? Or any location. So that is to do with flood zones, bushfire zones, and then we also look at things like heritage zoning and airport noise, right? And here we can see in the overlays, we can see heritage built on farm or heritage overlay, and we can see which pockets of Shepparton are under a heritage overlay. Now, we really want to be avoiding this mainly because of, like I said, the renovations, the subdivision potential. It can all be impacted because of the heritage overlay. And it's something you want to discuss with your local council as well. So that's a very, very quick example of how to do property selection when it comes to flood zones, bushfire zones, heritage zones. But there's still a lot more that you want to consider when investing into property, and I'm going to break it down for you. So say for example, now I've chosen these properties pretty much at random. And if we have a look at here, 20 Willow Street, Shepparton in Victoria. Now, obviously, I would automatically eliminate this property because it will fall under a flood zone next to the Goulburn River, which is normally very common for us to flood. But this is an ideal of what almost a perfectly good property looks like. A nice, well interior, 613 square meter block of land, so plenty of land available. Very nice interior, brick veneer, it's cleanly renovated. You can get a tenant in, great rent on this sort of property. It's excellent, right? This is the ideal scenario type property. Perfect in every single way. All right, so let's talk about land shape. Now, land shape is very important. We want to be looking at square shaped lands are not ideally triangle or trapezium. Now, the reason we want rectangular shaped lands like the one on 20 Willis Street or say 56 Patterson Road, if I bring it up over here and I show you in map and we have a look at this property, we can actually see that when it's a rectangular, it has usually a lot of space at the back, or in this case, this one does. This gives rise for subdivision potential or building a granny flat on the back. That's why I like to look at properties which have a good land shape or square. Now, triangle trapezium is not a deal breaker, it's just a trade-off when you buy property. Land size. I normally with land size, I aim for over 400 square meters because all the new cookie cutter homes are 300 square meters. And all we have to do is simply look at Melton or Melton South rather. When we look at Melton South, we can see all these new homes are built on 300 square meter blocks of lands, cookie cutter homes, which we want to be avoiding. And by the way, all these ones here, these are all trade-offs, right? They're not deal breakers, but they are trade-offs. Land slope. Now we want to be careful about buying properties on massive land slopes because they will generally require more maintenance, which means more money, which is not good for us. We want to save as much money and make sure we're buying on ideally flat ground where we can. We want to be looking at the year built, less than 30 to 35 years, because we want depreciation benefits. For depreciation benefits, if you're not sure, do some Google research on what it is, and I'll make a separate video about depreciation as well. But depreciation benefits is something that is very good for us in terms of cash flow. Land to asset ratio. Now, ideally, we want greater than 50%. It's not a deal breaker if we don't have that land to asset ratio perfectly. It doesn't really matter too much. I will not discount the property if it has a lower land to asset ratio. Proximity to nearest public transport. We want the location to be accessible to a bus stop or a train line because usually some people, they don't have cars. We want bus stops because they take their kids to school, for example, on the bus. So having the access to public transport increases the appeal of the property. Now, we want to be near primary schools and high schools for very obvious reasons. We want the kids to go to school. Are there any big poles or power lines in the front, right? When we look at properties, say this one, for example, here. This one is not such a bad power line. This is a common one. Like, if we can avoid this, it's good, but we don't have to completely avoid it, right? It's not a deal breaker, it's just a trade-off. Like, this one doesn't have a power line, much nicer. It's great, right? Now, let me also see if I can find an example where there is a major power line. Now, I had this property in Bendigo that I was looking at, and in this property, I have one of those major power poles and major power stations, which I don't like to see outside of a property. And I know it's not on this property exactly, and it's on this one, but it's not a nice sight to see. Now, of course, this type of stuff is not an absolute deal breaker, but they could be trade-offs for you when finding the right property, right? So any big poles, power lines, etc. in the front, it reduces the appeal of the property. It's not a deal breaker, but something you might want to trade off. Now, T-junctions, roundabouts, busy intersections, right? We want to be avoiding big intersections or properties near big intersections like this one here. This is an absolute no-brainer, right? I wouldn't be investing in this property here. Some people like to trade it off. For me, it's an absolute no. Lane of roads, thoroughfare, and main road. This sort of ties into the first point up there. We want to be avoiding properties which are on sort of main roads or busy roads or highways, generally because there'll be more traffic. It's less owner-occupier appeal. There's more cars, drive-by noise, etc. That's something we want to be avoiding in any location that we're trying to invest into. Number of bedrooms and bathrooms. Now, this is really important because most properties, or sometimes you'll find houses where there are 2x1. Normally, I would say no. There are very, very specific circumstances where I said yes, you should buy a 2x1. At minimum, we want to be looking at 3-bedroom by 1-bathroom houses, and townhouses, we can look at 2x1s or more. 2x1s is the absolute bare minimum, right? Minimum 3-bedroom, 1-bathroom houses. Number of living rooms. 1 is an absolute minimum. If you have 2 living rooms, that is more desirable. You will get more rent for that property. So if you do have a house that's a 3x1 but 2 living rooms or 2 family rooms, then yes. Air conditioners and fans. Remember, the more machinery you have in your property, it will just increase the maintenance costs. So if you have an air conditioner in every single room, just remember there are increased maintenance costs, but yes, it does increase the renter appeal. It's something you might want to trade off. Home build type. Now, this doesn't really matter if you really want to hold the property for a short amount of time. You can just buy a weatherboard home and then you can go for a joyride. However, if you plan to invest for the long term, you want to buy and hold a property for a really long time, then usually brick veneer or double brick is a good option to choose, and it has also more owner occupier appeal. So that's what you want to be doing, right? You want to be looking at brick veneer or double brick homes, in my opinion. Roof material type: tiled roof, metal sheet roofing. Tiled roof is the most common, most popular. You can have metal sheet roofing and other roofing types. You just got to be more aware of things, check for rust, etc. Foundation of house, another trade-off that you might want to consider. Concrete slabs are the most popular, it's the most stable, requires the least amount of maintenance. Stumps will require re-stumping after a certain amount of time, so just make sure you double check that. Again, it's a trade-off. Any large trees. I hate large trees, personally speaking. The reason I don't like large trees is because they have the potential for future removal costs and they can be very expensive. And not only that, on a day-to-day basis, it's pretty annoying because it clogs up the gutters and you'll have to get that cleaned out every so often. So those are vastly the large majority of factors when it comes to property selection criteria. And when you go through, all you want to do is sort of tick off like a checklist. Yes, this is covered. Yes, this is covered. Ooh, that's not covered. Okay, that's missing, etc. And you go through and you can do this for multiple properties, right? And then you can find out which property is best for you by simply doing this checklist. Now, is there more factors than this? Absolutely. But I have covered the main ones, and then these are all trade-offs, right? But remember, once again, that 80% of the equity uplift comes from buying in the right suburb, not choosing the right property. But if you're a long-term investor, then you want to be making sure you also buy the right property, for sure, right? And if you're wondering what this looks like, what type of properties you want to buy, there is so much information in the advanced property acquisition model. There is so much information in the advanced property acquisition module in the education program of the Property Blueprint that it is an absolute no-brainer for you to join in. And if you don't trust the education program at this point, I understand. Join the private community. You'll get a special discount as well. And then you'll also be able to understand how much value this program can bring to you. And you can ask me questions directly. So I hope this video has been helping you so far. It's an absolute belter of a video. There is so much information jam-packed, and there's still so much I'm going to unload onto you guys, all right? And I help you guys out. So make sure you are watching right through till the end. The reason why I have got this up here is I'm going to teach you about how you go about finding the right price to offer for the property that you're interested in. And it's very, very simple. If you're buying a car and you're buying the Suzuki Swift here, what is the most logical step that you're going to do? The most logical step that you will do is you will then go and compare other cars that are similar to the Suzuki Swift, and then you'll see if that's a fair price or not. We can see that this car is a 2018 Suzuki Swift GL. We can see it's a very nice car. Okay, good interior, good exterior, and you look through the car, you look at the pictures, okay, it looks very nice, etc. And then you go and look at the other cars. So this one's $1699, $2699, but that's a 2020 model, right? Okay, this is a 2018, 2020, 19,250. Seems appropriately priced. 2018, 15,990, 16,990, 85,000 Ks. This seems like a really good price. Or can I get it for a little bit cheaper? And this is what you do. All you have to do when you're trying to offer a price for your property that you're interested in is you have to go in and you have to compare the property that you like with the property that you want to buy. It's as simple as that, right? Don't make it overcomplicated. Don't be silly. Don't be foolish. Say I'm interested in this property, 20 Will Street, Shepparton in Victoria, 485 to 525. Here is what I'm going to do. I'm going to go to realestate.com. I'm going to go to Shepparton, and here I'm going to go to filters. I'm looking for a house. I don't care about the price maximum, but the bedroom minimum is 3. Bathrooms 2 plus, and I'm going to do search. And we want to be looking at 3x2s. This is a 4x2, 4x2. This is a 3x2 in Moranupna. That's a 3x2 in Moranupna. There's a 3x2 in Shepparton. Another 3x2. That's 590, for example. Here we've got one for 3x2, 462. And now we're going to simply compare. That's all we have to do, right? And in our property, we have a 3x2, 613 square meter block of land. And you go through the photos. Okay, it's a very well interior renovated property, new carpets, new tiles, new paint, etc. All right, very, very well done property. Now we go through our examples. Okay, this one's in Moranupna for 475. Also very good interior, very good kitchen, very good tiles, etc. 696 square meters of land, but this is in Moranupna, so a less ideal pocket of Shepparton, for example. This sold for 475. So immediately I'm going to think, okay, if this is 475, then I need to offer more than that. More than this for this property because it's in a better area. It's also freshly renovated, similar block size, and also 3x2. And this one already says 485 to 525. So I'll already be looking at in the range of maybe 485 to 490. We can look at another property. Okay, this one 475, 669 square meters of land, but the shape of the land is not so good. It's also on a T junction, but it's also renovated inside, but not as nice or not as neat. A lot of the land is unusable, doesn't really have a backyard. The bathroom isn't nice. Okay, so if this is 475 without a nice bathroom, this is 480. Has a nice bathroom and freshly renovated. So I'm going to be looking at maybe 490, 500 for it. Let's have a look. This one is 590, so it's way over the budget. So let's have a look why this property is so good. 664, so still very similar. But it's got a nice pergola and a nice backyard with a playground, very good interior, nice shed, great house. I mean, it's absolutely stunning, right? It's a very modern, respectable house with a good, decent bathroom. But this is 590, so I think this is a little bit, overpriced or oversold, you can even say. So I'm not going to offer 590 for it. I'm going to offer less. Right, I'm going to offer, and again, keep it within the range, be sensible. So I'm still going to stick to $490 to $500 for it, 500,000 for it. Here we have 3x2, 462. We have got an interesting property, not as nice. This one does have a pool. Again, I would discount this property immediately, but here's the thing, it's not as nicely renovated inside, and this is sold for 462. So you can already tell that I'm going to be offering at this point at around 490 to 500, maybe 510 even, around that sort of price range. But this is what you have to do, right? You take the property you're interested in, then you compare it with other properties that have been sold, and then you make a decision for it. It's not that hard. It's as simple as buying a car, right? You look at what the property's been, you look at what the car is advertised at, what you expect it to be sold at based on other comparable prices, and then you put an offer matching that. And they will more likely accept it. And you don't want to go over that price because you're an investor. You're not an owner-occupier who's willing to overpay for the price and hold the property for 30 years. You're an investor. You don't want to pay more than market value. You don't want to pay more than market value, and you're trying to get bang for buck. And that is how you identify what price you want to offer the property at. You do it by comparing your property to the other sold properties. And it may seem obvious, but I still get questions about it. So I just wanted to teach you guys. Now, if you haven't already, make sure you guys are part of the free private community. Think about how much more value I can add to you guys in the community, answering your questions on a daily basis. That's how much value there is. It's an absolute no-brainer. It's $35 a month. Try it. If you don't like it, you can leave. No one's holding you hostage. I'm here to help you. That is my goal. I just want to help people. All right. So what happens when you like this property? Say you have this property and you want to offer $500,000 for it. Perfect. How do you do it? You write an email to the agent saying, hey, I am interested in this property. I want to offer you $500,000. It's ideally not best to negotiate on the phone. You can offer on the phone if you want to, but they might not take your offer seriously. So you want to offer $500,000 and say you want to request for the contract of sale. Now remember, you can put as many offers as you like on a property until you sign the final contract. And then usually once you place an offer, the vendor will aim to get back to you within 24 to 48 hours after talking to their client. After you place an offer, the sales agent will talk to the vendor and usually will get back to you within 24 to 48 hours. And then if they accept your offer, you will then exchange contracts, you will sign it, and you'll enter a conditional contract of sale. That conditional contract of sale has certain conditions like a finance clause and a building and pest inspection clause. And you also have a cooling off period in that time. During that period, you have an option to exit the contract based on the finance clause and the building and pest inspection. If you do not exit the clause within the cooling off period, the finance clause or the building and pest inspection in the conditional phase, and it reaches unconditional, then you have pretty much bought the property. You are legally obliged to purchase the property and you see through the property transaction. So it's really important. Once you place an offer and they accept it and you sign the contract, right? Make sure your conditions are met and then the property is yours. And then you do the handover. But that's a simple run through about placing an offer, doing the property transaction, etc. I hope this video has helped you, right? It is a free property investment guide. It's completely for free. So many people charge so much money for this. No one wants to share the secrets, but I'm here helping you out. And if you think that I give so much value in this one video, think about what I can teach you to become the top 1% of property investors out there, and all for the small price of $299 on pre-order, because once it is full price, it will not be as affordable, right? So I'm here to help you guys. I'm here to help you become better investors. So make sure you pre-order the course. It's an absolute no-brainer. And if you haven't already, subscribe to the private community. After 150 members, the price to the community will also be increasing, right? So make sure you get in before it does jump up in price. It's an absolute no-brainer, guys. Join up, and I'm always here to help. And I really hope that you find this video engaging, useful, and helpful. Till next time, thank you.